Let us move on from here. The next aspect what I am looking at is, I am looking at holding period return. What is this holding period return? How is it different from the normal return out there? Holding period return is a return that the investor would get when holding an investment for a number of years, for T years out there. Suppose you buy an you make an investment and you wait for 3 years. Typical, let us look at the national savings certificate. What happens? You make the investment now, you have to wait for 7 years or 6 years, whatever the scheme that is available, and then wait for that, and then basically look at the money, you are going to get a lump sum out there. So, you are holding that instrument for 6 or 7 years, and then you are going to get a lump sum payment. So, you are looking at the typical holding period return is what we are looking at in those cases out there, and that is what we look at out here. I have taken an example, I have calculated the holding period return, or I am going to do it even on Excel. Supposing if the returns were 11%, 5%, 9% for a 3-year period on an investment of $1 from the beginning of the period out there, how are you going to calculate? I am going to say 1 plus R1, that is the capital plus R1, R1 is 11% return, plus this this return, and the capital is going to be reinvested in the next case out there. That is what happens, plus 1 into 1.05 plus 1 into 1 plus 0.09, whatever it is out here. Your holding period return in this particular case is 15 years, 15% in this particular case, and that is what we calculated. That is, I said, reinvesting the first year dividend in the stock market for 2 more years and reinvesting the second year dividend in the for the final year out there. So, that is what happened, reinvesting. That is, if I have to use the simple word, compounding is what is happening out there, and that is where you look at the holding period return out there. Every year the kind of return. So, very simple. Imagine you invest in a NSE, and NSE, or you invest in an instrument for 5 years. You make an investment today, and then you are going to get what is called some money only at the end of 5 years out there. Imagine the rate of return is 6%. So, what happens? $100 you invest, at the end of the first year, that $100 would earn 6% interest. So, the capital for the second year becomes 100 plus 6, 106 out there. That 106 is going to earn 6% in the second year out there. So, third year your capital would be 112 point something out there would be the capital, because the 106 would have earned about 6% interest out there. So, third year capital is 112 point something. So, third year that 112 point something earns interest of 6%. So, what is happening? That is getting compounded, and that is what we call it as the holding period return. I got a simple example out here. Let us solve this example in this particular case out there. Let us solve an example out here. A stock had returns of 14.38%, 8.43%, 11.97% and 25.53% and minus 9 point whatever 1.17% over the past 5 years respectively. What is the holding period return on that stock out there? So, what is the holding period return for the stock out there? Let us move to example 5. I basically try to give you a formula also in this particular case, holding period return. Holding period return, let us sort of look at in this particular case 1 plus my first year return out here, and then into 1 plus my second year return out here, into 1 plus my third year return out here in this particular case, into 1 plus into what is called as 1 plus my fourth year return out here, into 1 plus my fifth year return out here, and then the whole thing basically minus 1 out here, because I am looking at the return, and this is the entire capital out there. So, I am basically looking at I just, instead of a star, I think I put a 8 out there. So, that is 1 second. Let me correct it, and I think it should have been a star multiplication out there. I just put a by mistake, I put typo out there, and that is it, and that will give me what is called as 58.71% out there is the kind of return. So, what happens? Why do, if I do not do this minus 1, then what happens? Nothing happens. What happens? It says why your return is 158.71. That includes, it is not the return alone, it includes your capital also that you have basically put in. It also, it is not your return out there, it is the total gain. So, what happens? Minus that 1, that is what is the investment, that gives me my 58.71% is the kind of return that I am basically getting on this investment, and this is what we call it as the holding period return. Holding period, I held it for 5 years. At the end of 5 years, what is the kind of return I have got? 58.71% is the kind of return I have got. In this particular case, there is not return per annum, this is the holding period. Please note, this is not return per annum, this is the return that I am getting for the entire period I am holding that asset. For the entire period that I am holding that particular asset out there, and that is what we call it as the holding period return. Next, I move on. In this particular case, we also look at what is called as historical return out here. I have taken an example from the textbook. Let me tell you, I have taken this from, picked it up from the textbook. So, it describes about the US market, that is, they have discussed about the historical return of the US market right from 1926 to 2015. Now, what are these multicolored lines? Each line indicates something, that is, the red line indicates small stocks, company stocks, what is the kind of return they have got. Large company stocks, blue line, long term government bonds is green, and then the purple is basically treasury bills, and the orange is what we call it as the inflation returns out. The returns that they have got from a period of 1926 to about 2015, this is what we call it as historical returns. I have got one more slide which gives this description in complete detail, year wise detail it gives. What is the kind of year on year, what is the kind of return I have got. From 1926 to about 2014, what is the year on return I have got. You can see this. Year on year, I have not been consistent any year. I have always got negative, positive, very high return, very low return. It's been basically completely fluctuating out there, the US market out there. Now, let us say I can calculate the holding period return for any combination of years. Let us take one combination out there. Let us take the dot-com bubble, 2000 to 2003. I have taken the dot-com bubble of 2000 to 2003. If I like the dot-com bubble of 2000 to 2003, in this particular case, I am looking at 2000, I had a negative 9.1%, 2001, I had negative 11.89, 2002, I got negative 22, and 2003, I had a positive 28% return out there. And that is exactly I was calculated. I said, overall my return is negative during that period. If I had made any investment, on an average my return would have been negative 3.54%. I also looked at another example as a financial crisis, 2007-2008. I am sorry, this is not 2880, this is 2008 out there. That is a small correction I need to make. I think I am unable to correct it here because it just got pasted as an image. Do not worry about that, make it as 2008 out there. 2009 and 2010. Again I go back to the same thing, 07, 5.49%, 8, 37, negative 37%, 9, 26.46, 10, 15.06% out there. So, and that is what I have basically taken. The negative return is so large, 37%, that it is basically offsetting all the other returns out there. My overall return is negative 3.3% out here is what we see. Moving on, we look at return statistics out there. History of stock market returns is always too complicated because you never saw a pattern out there. We projected return from the textbook from 26 to 2015 and we never saw any pattern out there. It is too complicated. Single measure that best describes the past annual return on the stock market, what is that? What is the best estimate of the return that an investor could have realized in a particular period, particular year or a period out there? So, what we say, the answer to all this both out here is average return. What is single measure? Average return. What is the best return that the investor could have realized? Always the high end or the low end out there, average. We look at average return out. How is the average return measured? Out here, average return is your sum of your returns divided by the number of your returns. That's very simple out there. This can be called as your frequency and so on and so forth. In this particular case, I have got an example. Supposing the returns on common stock from 26 to 29 or whatever is the numbers I have given out there respectively, the average or the mean return on these 4 years is basically what we look at. We are looking at calculating the mean in this particular case out here. The mean return, I am looking at example number 7. Out here I am just looking at the average out there. So, to calculate the simple average, what I, because I am using Excel, I am just going to use what is called as a formulae out here. I am just take the average of these and that is it. I am just going to give you my average return is about 21.44% is what we sort of see in this particular case, and that is all what I am going to talk about out here. Moving on further, what happens? Whatever the returns what you see out here, that is absolute numbers out here 27.409 and so on and so forth for each of these, we can look at the averages out. The average return of large stock is about 12.1% out there in this particular case. Let us compare this with the securities, with the T-bills and so on out there. As risk changes, your return also basically changes, because you cannot compare the long term government bonds with the small company stocks out there, because the returns are going to be very, very different. You are looking at the risk return. I just looked at the arithmetic mean. I said small stocks had a return of about 16.7% out there, large companies about 12.1 and so on and so forth out there. You can see in this particular case out here, that is historical returns out here. You can see the reason out there. If you look at the average excess return that the large companies as compared to the T-bills, T-bills gave me a return of 3.5%. The large company stocks gave me a return of 12.1%. So, the return that the large company is earning, large company stocks excess return is 12.1 minus 3.5, and that is what we have basically given out there. That is, the investing in large company stocks gives me 8.6% higher than investing in T-bills out there, and that is why we call it as the excess return. That is, investing in large company stocks give me 8.6% more return than investing in T-bills out here, and that is what we see. So, the excess return is a common language that basically used, and why is there? That is, reason is additional risk for bearing additional return is for bearing additional risk out there. Risk return relationship, is it assured? Never assured, but expected. So, what is such a reward out there, or why there is such a reward out there, and what is the variability in the returns out there, and that is what we talk about in the next session out here. That is what we talk about variance and standard deviation out there. I am just going to move on the next slide out here. Because we see that returns from common stock are frequently negative, because you can see that common stock out here constantly it is basically going down all the time out there. Whereas you look at the return on T-bills, it is a single straight line. That is what you basically see out there. It does not have the negative fluctuations out there. T-bills never produce a negative return. T-bills always produced what you call it as the positive returns out there. Now my question is, the common stock is producing negative return, positive return, negative return, and then it moves on volatile like this. I need to measure to what extent it can vary from the average. To what extent it can vary from the average out. The variability, because why is it? Variability tells you the risk. If the variability is very high from the mean or the average, then what is it conveying? That is, the probability that it will go down is very, very high. The probability it will go up also is very high. I do not deny that. Probability it go down is also very high out there. Variability is very high. If the variability is within a very small range, then your risk is low, because you may not lose much, you may not gain much, agreed, but you may not lose much also, so you are sort of protected out there. So, the variability becomes an important measure out there to measure the risk, and that is where we talk about in this particular case the risk statistics out there. We talk about what do we call it as uncertainty and so on and so forth. We can measure it by the risk is measured is by variability is measured by variance and standard deviation. Variance, what is the variance? What is the variability? And the standard deviation, how much does it deviate? out there from the mean. That is what we talk about out here. I am going to take one or two measures of examples out here. Variance, that is what, and its square root, that is the standard deviation, are common measures of dispersion. That is how much I take about 10 values, I have a mean value. How much does the maximum variation has happened from the mean among the 10 returns on either side out there? That is what we talk about in the variance out there, the formula for variance. I have taken a small example out here. Supposing the returns on common stock are in 0.13, 0.35, 0.45 and 2 point something respectively. Now tell me what is the variance and standard deviation in this particular case. Tell me what is the variance and standard deviation. Firstly, let me say what is the average out here. What is the average I need to know? That is, I need to know what is the mean, what is the average out there. I need to know what is the average or what is the mean out there, what is the average out there. I have got my average. Average is about 21.44% out there. Now let me look at this variance and the standard deviation out here. My average in this particular case out here is about, I have taken out here is basically about 0.21, that is what I have taken. Let me increase the number of decimals out there to 4 here, and it is 0.2144 is the basic number that we are basically talking about out here. That is the kind of average out there, and I am going to do this variance in this particular case out there in all these cases. Let us sort of do it manually. I am not going to use the formula out there because I need to help you guys understand that calculation. That is why I am not going to use the formula. As we can directly calculate the variance and standard deviation by the formula out here. I am not going to do this. Now first step I am doing is what is the deviation that each of these 4 returns have from the average. What is the deviation that each of these 4 return is having from the average out there is all that I am basically calculating out there, and that is all what we talk about in this particular case is deviation. What is the squared deviation out there? Squared deviation out here is this to the power of 2 out there, that is square deviation in this particular case. So I am basically looking at this to the power of 2 out here, squared deviation in this particular case. I am just squaring these deviations to find out the variance out there as squared the deviations. What is the total of the squared deviations out here? The total of the squared deviations out here is nothing but 0.1745741. What the variance is? The total of the squared deviations divided by the number of observations minus 1. Number of observations is 4 minus 1, number of observations minus 1. That is the squared total of the squared deviations minus number of observations minus 1. So the variance is 5.82%. That is, the on an average the return can vary at about 5.82% from the mean. What is the standard deviation? The standard deviation is nothing but SQRT, in this particular case square root of the variance out there, and square root of the variance out here in this particular case out here. I can just square root of the variance out here, and I am just going to type in this figure out here in this particular case, and that is all what we have. Square root of variance is about 24.13% out there. That is, the variance is 5.82. Square root of that variance is what we calculated out here this particular case. Let me go ahead with this. Let me just go ahead with this. Let us go to the next slide out. I got number of examples. I am going to go through each of these. Using the following returns, calculate the average return, the variance and the standard deviation for x and y both. Let us try and do that. Let us go back to the Excel sheet and let us try and see if we can do that out here. Let us go to the Excel sheet and let us do it out here, and then Excel 9 out here. I am doing it for basically x out there. I can do it for y also out here in this case. the average return, I am just going to calculate what is called as my average return out here. I am just using the formulae for average return out here. I am just using the formulae for average return out here. I am just doing the average in this, basically the both for it, and then I am just calculating the average out here in this case out there. I can just directly calculate the deviation out here. The deviation would be 9 minus what do you call it as 8.2% out here. I can just fit a dollar symbol in this particular case, so that I can pull this figure out here in this particular case. So, this is basically my deviation out here. What is the squared deviation? I am sorry, squared. What is the squared deviation? I have this to the power of 2 out here, to the power of 2 out here is basically happening, and that is all what I have as squared deviation out here, and then I can just do the total of the squared deviations in this particular case. The total of the squared deviations is also done out. What is the variance? Variance is very simple. Variance is the squared deviation divided by number of observations minus 1. Number of observations is 5 minus 1 out here, and that is all what we basically do. Variance is expressed in the form of this, but it can also be expressed in the form of percentage. Whatever it is, you can basically sort of look at it out here, 4.172. What is standard deviation? Square root SQRT, and then do this of this variance out here, and basically do this. That is 20.43 is the standard deviation out here in this particular case. The same thing I can do it for y also out here. The same thing I can do it for y also out here. I am not going to do it. I can set, I can do it out here, and that is all what we are looking at out here. I move to the next problem out here. You have observed the following returns of Skynet data stock over a period of 5 years, 21, 17, 16, 27 and 4%. What is the arithmetic average return of the company stock over the period of 5 years? What is the variance of the company's return over a period, the standard deviation only. So, let us go back and see this particular example, example number 10 out here. These are the returns, these are the deviations, these are the things, these are the standard deviations out there. Very easily I can basically calculate each of these like we did in the earlier case, and then we can just what do you call it as take it from here out here in this particular case, and I can just do it out here. What is my average? My average return is very simple. I am just going to do the average out here. I am just going to take this out. I'm sorry, I did the sum. I got to do the average out here, and the average out here. Let me basically look at whether it is till D24. No, it is till D23. So I am just going to do this out here till here. What is my deviation? My deviation is my annual return minus my my deviation is my annual actual return minus the average return. What I have is basically the deviation out here, and let me put an what do you call it as a dollar symbol out there for uniformity out here. I am just going to do this, calculate it. I have just done this calculation out there. What is the squared deviation out here, and any problem with my average? No, it said sum. I am sorry. That is why I said it should be an average out there. It should be average. That is where it's. I am sorry, I calculated the sum instead of the average. It is just the average out there. I just made a mistake there. I am just doing the average. I have got my average. I am just doing my average out there. I am just reducing this. I am just got my average, and I have got this. What is my squared deviation? That to the power of 2, and then I am just going to pull this out here. That is what is the squared deviation out here, and what is the sum of the squared deviation is all that I am basically going to do out here in this particular case, the order sum out here. So, what is the variance? Variance is sum of the squared deviations divided by number of observations minus 1, number of observations is 5 minus 1, and that is it. It is about 18.1 point whatever it is 8%, and what is this? SQRT, and then it is just moving up out here and closing. It is just SQRT out here, that is square root in this particular case out here, and that is all what we basically have. That gives me my standard deviation is 13.48% out there, and that is all what we have got. Moving on from here, I just have the same thing, distribution. I have expressed it in the form of what you call it as picked it up from the textbook, again in the form of your graph and so on and so forth out here. Typically, when you analyze a stock out here, I have just taken from moneycontrol.com, just one of the mutual funds out there. It gives you all these ratios out there, that is standard deviation of 5.86%, average standard deviation in this sector is 7.34, beta is 0.71, Sharpe ratio, Tainer ratio, Jensen's alpha, and so on and so forth. So, what do all these things mean out there? And it gives you all the comparative stocks out there. Average return form a measure, it measures over the last 3 years. The investor's fund has earned about 12.6% per year, that is the kind of return what we see. Standard deviation, that is deviation of the returns is about so much percentage, relatively well diversified portfolio. I am all talking about all that in this particular context out there. Standard deviation is about 5.68% out there, and that is how we interpret it. Beta talks about the volatility of the fund performance compared to similar funds in the market. Volatility, how volatile is your fund compared to similar funds in the market, that is what is beta. How do we measure beta? We will talk about how do we measure beta in the next session out there. We will talk about how do we measure beta in the next session. Now, Sharpe ratio is the risk premium of the assets divided by your standard deviation. It measures the risk to reward ratio in this case. Tainer ratio, it talks about how much of excess return is generated by each unit of risk you take. That is, risk premium of the asset is divided by the beta of the return. And then Jensen's alpha, how much return is fund, how much own fund generated additional returns out there. Let us not dwell deeper into this at this stage. We will dwell deeper into this as we go along in this particular course. This I have just picked it up. Moment I type in any mutual fund out there, this gives me this particular analysis chart out there. Now I am reading, understanding the analysis. That is, average standard deviation of mutual funds in this sector is 7.34 category average. But my stock, this ICICI Prudential Balanced Advantage Fund Direct Plan Growth is deviating only about 7.65%, so it is better than the average bell. If I am a little risk averse, I would choose this, and then so on. Volatility, the beta, the average category is about 0.91, whereas this particular stock is volatile only about 7.71 movement out there. So I would choose this. Tainer, Sharpe and Jensen's alpha, slightly different. We will come to that again, though I gave you a brief slide on that. We will come to that again. So in the next class we will continue as we go along. Thank you.